Hi everyone. Today's topic is where to invest, whether in large cap mutual funds or small cap mutual funds. So small caps I would elaborate as small cap, multi cap and mid cap funds. So new investors, especially the new investors or the fresh investors, are always under a confusion that where should I invest, because there are a lot of mutual funds, there are greater fund houses or renowned fund houses available offering various types of mutual funds. So people are always having a confusion, or they are misinterpreting it as if it is large cap, then the return will be solid and it will be consistent compared to a small cap, which is highly volatile. So I should always go with the large cap funds, and my mutual fund SIPs, everything should be invested in some large cap funds. So this is, as per me, a clear myth. So you should have a mix of various mutual funds. So we'll elaborate all these things in this video. First of all, if you are young, I would say from age 23 to 45, I will call it as young, comparatively young. So in that case, you should invest in aggressive return funds like your small, that is small cap, mid cap, or even multi cap funds. You should not fear for the risk, and you should not be such a conservative investor at that young age, wherein you can take a lot of risk and you have a lot of time to compound the wealth. Unlike a aged person, say in his 55 or 65, wherein he is looking out for his retirement, wherein he cannot risk his wealth, or he don't have much time to compound the wealth. So in that time and in that age, you should look out for stable returns in bond funds or in conservative large cap funds. Even if you see the performance of large cap funds, none of the funds, I can confidently say, none of the funds, the blue chip funds or the large cap funds, mutual funds, has remained in a particular ranking always. If you see every year, so the rank keeps on varying, or maybe the ranks are degrading into such lower levels of below 20, wherein that fund would have been performing as a top within 5 ranks in the previous or year before that. So that is the particular thing with the large cap mutual funds, because the fund manager, if he is not rebalancing his portfolio, or if he is not an active fund manager wherein he has his viewpoint of giving time in the market rather than shuffling the stocks, the blue chip stocks, then the returns also would be slightly lesser. Obviously the returns will be higher than the traditional fixed return instruments, but it will not be comparable to the funds such as small cap and mid cap funds, because small cap and mid cap funds are funds, or the portfolio of that fund will be having stocks wherein the stocks are in a smaller value and they are in a inflection point or in its travel to reach a mid cap or a large cap fund. So in that travel they will make bigger returns, unlike a large cap fund wherein it has already started from a small and reached mid and then large cap. Then from there the growth will not be higher, so the growth will be minimal, like 10%, 10-12%. So the returns also will be accordingly reduced, because a mutual fund house has its own management fee, so in the form of expense ratio. So after deducting the expense ratio, and if you are going with a direct fund, then you will have slighter advantage over the NAV. Otherwise, if you are going with a regular fund, which I don't recommend, in that case then you further have a reduction in the appreciation of your investments. So in such a case your returns also is subdued. So that is why I recommend that based on your age you have to select your mutual fund. So if you are young enough, go for small cap or mid cap funds, go for the rankings, go for its past performance, utilize the websites like Value Research, wherein you can go see what is the fund holding, what is the portfolio of the fund, what is the mix, how much in equity, how much in cash, how much in bonds, or things like that. And then see the top 10 holdings, like I told in my earlier videos of how to evaluate a mutual fund. Then in that, if you find that these are good stocks, good small cap stocks which have a potential to go and deliver a multi-bagger return going forward, then obviously you should select such mutual funds wherein you have got that risk taking capability and obviously the risk reward ratio, and this will help you generate great profits. Like your stocks, the mutual funds also, you have to give enough time. So if you are young, then you have enough time, 20-30 years you can give ahead for that mutual funds to create great wealth. And also you have to keep reviewing your returns or the portfolio of the mutual fund and their change in fund managers. So if you see some fundamental changes in the mutual fund, then you can stop one mutual fund SIP and you don't redeem that, let that money compound and start the equivalent amount into another mutual fund SIP and continue with that new mutual fund SIP. So you can keep stopping and starting the various mutual funds SIPs, but don't stop increasing the amount, or like I told in my earlier video, 20 to 25 to 30% of your salary should be mutual fund SIP, and that amount should keep increasing based on your increments year on year. But you can stop various mutual fund SIPs if you see that is underperforming and switch to another mutual funds, but that amount should keep on going every month. So this is the basic difference between large and small cap stocks. So both are good, but returns are obviously seen higher for small cap funds because of their growth potential, and if you give it larger period for it to compound. Hope this video was informative for you. If you have any comments, please feel free to comment in the below comment box. If you like our content, please like and subscribe to our channel so that you get similar content on investing to make you research by yourself and become an independent investor. See you in next video. Till then, happy investing.